Okay, welcome everybody. Good morning or afternoon, wherever you are. What is going on? Well, the sun just came out. Stream was looking okay a second ago, and now it seems to be blasted out background, but what can you do? So hopefully that doesn't bother people too much. Thank you for joining me here today. It's been I don't know, maybe 10, 11 days or something since the last live stream. So I thought we would do one just before I head out. This will be the last time that I'm in this place. And then we are moving on. So we will be in Banff, Alberta. Hopefully some of you have heard of it. It's pretty beautiful. It was basically where I grew up. I was born in Calgary. So taking Vanessa over to Banff for a few weeks, and we're going to be able to see in all the areas. Basically, that's going to be our home base, and then we can go to Jasper, we can go to Lake Louise, Kananaskis, all the cool places in that area. So looking forward to it. Just wanted to do a Q&A today because I'm not yet sure about the internet. So I'll definitely try to find something, and we'll do the live streams every week, but can't guarantee that it'll be immediately. We're going to be on the road for a few days, so let's get that done today. The last live stream that I did, I was actually talking about the future returns of the S&P 500, and in my opinion, maybe is going to be quite low going forward. So what I actually mentioned in that one is that we are going to do bonds as well, because same situation. Bonds going forward are going to be pretty abysmal as well. And then I'll probably wrap up a third live stream later on with what I mentioned is 60-40 balanced funds and regular stock investing, portfolio management type stuff, and why, again, I believe that certainly in the next 5 or 10 years, it's a pretty grim picture. So I definitely want to finish up that series. So maybe look for next week. We will continue on with the analysis of the bond market. And probably people watching my live streams, you're not buy and hold investors, but it is worth going over those things and maybe just reinforcing why we don't want to be buy and hold investors going forward. So I will get to that for sure. Let me just play the little intro, and then we're just going to get right into the Q&A today. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so welcome everybody, and today is just going to be entirely the Q&A session, but I do want to try something different because, as many of you know who have been following my live streams, there is a little bit of a problem with how many of the questions I actually get to see. So I'm using a live stream software called Ecamm. It's probably the best one, the easiest one to use for Mac computers. And I've got the comment section out in front of me, and the cool thing is, I'll just highlight the first question here, just to show you what I mean. If I'm using my software, I can actually just click on somebody's name, I can highlight the question, and I feel like it's a little bit more interactive. One of the issues that we've encountered is it does seem like some of the questions coming through YouTube are not being highlighted or shown to me on my end. So one thing that I was doing a little bit of research, and somebody online mentioned that it might actually help. I should take my own advice here. Just give me a second. For me to click live chat, so make sure it's on the live chat. And the second thing is, if you do have a question, just for today, I know it might sound a little bit annoying, so we're just going to do a trial run today. Type question before you actually ask your question. Apparently, the YouTube algorithm might be able to pick certain things up like that, and who knows, maybe it'll be better. So obviously, I can never get to all the questions on the bottom, but what I try to figure out is why I'm missing some of them in the middle of the stream. So get your questions in early, type question, and then when I edit the whole thing and do the time stamping later on, I'm just going to sort of cross-reference and see if we made any progress. So if your question is skipped, apologies. It's really not me skipping questions. I don't see them all on my end. So let's get started. First question, a little bit off topic here, but Vanessa is on the plane right now. So fingers crossed, everything works out. For people who don't know, Vanessa and I have been apart for a year because of all the COVID protocols, and I'm personally not allowed to go to Taiwan. They shut that down. She was not allowed to fly to Canada for pretty much a full year now. And as of yesterday, they opened up international travel, non-essential international travel. So, of course, we just immediately booked a flight, and she's on the plane now. COVID test in hand, all the proof of where she's going to quarantine and all that stuff, double vaccinated, everything should be okay. So fingers crossed she'll arrive, and then tomorrow we'll head out and we'll drive through the Rocky Mountains and head out to Banff. So should be a fun, hopefully 3-month road trip, and then we'll see where we end up next after that. If they open up the world, then maybe I'll go back to Taiwan for a few months. If they don't, maybe it's back to Panama, Dubai. I have no idea, but fingers crossed. Yes, this is looking promising that Canada at least hinted towards opening up. So good to see. Okay, I'm interested in learning in depth about broken wing butterflies, I assume. I understand they are adjustment friendly if needed. Can you say anything about the nuances of trading these and a good source for more information? So a good source beyond me. I hope I'm a decent source for option trading strategies. I do have a couple of full videos on broken wing butterflies. If you're in the private community, sorry, it's just a first name. It just says Hans, but of course I recognize the name. If you're in the private community, we also have private live streams talking about broken wing butterflies and how I use them for the overlay. Essentially, there's really nothing you need to know beyond the fact that what they're best used for is taking somewhat delta neutral strategies, right? Say a classic iron condor or an iron butterfly. And essentially, because of your broken wing, you're shifting some of the risk from one side of the trade to the other. So it is still a controllable trade. It's not quite delta neutral. There's some directional exposure when you break one of those wings, but you're essentially choosing how much of the risk from one side you get to move to the other. So broken wing butterflies are really cool for people who really understand that making active market predictions is a tough game to make money on. If you're just all out saying, okay, it's going to go up to here, it's going to go down here, it's actually pretty tough to structure trades that profit long-term from that type of option trading, because of course we can all be wrong, and let's be honest, we're wrong quite regularly. Hopefully we're wrong a little more often than we're right, but as far as maybe 60-40 or something, we're going to be wrong quite a bit. So the broken wing butterfly allows you to, if you are wrong, there is going to be a loss involved, but you can still take a little bit of directional exposure. So what I would just say is pick your underlying, and like anything in the trading world, just get in there, start trading, and figure out what works for you. Do more of what works, less of what doesn't. So for example, if you want to start doing broken wing butterflies on VXX, let's just say it's a liquid product, or the VIX or the SPY, whatever it is, but pick something and then just get into the habit of betting small, maybe single contracts for a while, and just figuring out a strategy that works for you, that you can take a little bit of directional exposure without really significant penalties if you are wrong. That's the benefit of them. And you'll learn as you go. I mean, like I said, trial and error. Do more of what works, less of what doesn't. That's really what all trading is. And I think if you track it in a spreadsheet, track all your trades, that's always very important. eventually you're just going to come out with strategies that work really well. I think the key to understand here, you're asking specifically about broken wing butterflies, but it's worth reminding people that there really is never any edge or advantage to the actual option structure. A lot of times people think, well, I'm going to be a profitable option trader because I trade iron condors. I sell iron condors, right? They think, well, I'm short premium. That's the winning side of the trade, they've been told. And iron condors are great and they win most of the time, they've been told. So they think that that's the edge. The actual structure of the option is fairly irrelevant. Obviously, you want to have a toolbox and you apply them to certain things, but there's no actual edge there. What you really want to do is just get comfortable with a certain strategy. If it is broken wing butterflies, great. They're definitely a structure that's easy to work with. But there's still no edge there. You have to actually go out into the market and find your edge through timing, through position sizing, through figuring out how it interacts with the rest of your portfolio, the correlations, your beta factor to the larger core part of your portfolio. You have to find your own edge. The broken wing butterfly itself is not the edge. Knowing that volatility typically trends downward, that is not an edge. Everybody knows that. Knowing that selling premium more often than not will have the higher winning percentage, but more downside risk, that's not an edge. Everybody in general knows that. You're competing in the option market against people who they know quite a bit. These are not unsophisticated traders, especially when you're doing options within the volatility space. You have to go far beyond just, well, I'm going to just trade broken wing butterflies, or I'm just going to sell iron condors on a certain calendar schedule. That's not an edge. There's nothing there. You have to go above and beyond. And the only way you're going to learn what your edge is, whether it's informational or positional, trial and error. Record everything, trade often, trade small, of course, and try to find some actual edge. But short answer, I also like broken wing butterflies. I think they're a good starting point. Okay, so looking at your 1-year volatility barometer, it looks like there's a slowdown trend over the last month from 40 to 60 to 20 to 40. Where does that come from? Does it imply a change volatility regime? So let me do a screen share. What you are getting at here is this is the last 1 year of our volatility barometer. And yes, of course, clearly, actually, while I'm talking here, I'm going to open up the right spreadsheet just so I can talk about this stuff. So where's my thing? Okay, so yes, I've been talking about this quite a bit, how there's definitely been a shift upwards in volatility since February 2018. That's the spreadsheet that I'm going to open in a second here. Although, you know what? I think I just closed the one that I need. Sorry about that. That is the right spreadsheet, so we'll reopen it. But there, essentially, volatility for, say, the last 10 years was averaging around 40, something in the low 40s. Let's open up that one. That was the right one. And now, because we've seen a period where actually realized volatility on the SPY or the S&P has been quite low, and volatility is slowly following suit. So it has been trickling down lower. Now, as to your question, does this signal something new? I would say we need to be patient. We need to understand that market environments themselves are more macro views. They're longer term trends. We don't want to get too excited just because we have seen a couple of months of lower volatility. I would say it's definitely a little bit too soon to be saying that we are again seeing a volatility regime change. But it's somewhat promising that we are dipping, as far as my barometer goes, down into the below 30 range. But certainly from 20 to 40, we're seeing many more readings than we were sort of in the last 2 to 3 years. Let me pull up the longer term chart and you'll be able to see it much more clearly. Okay. I apologize again. This is not the right spreadsheet. Sorry. What's happening here is I've been talking about it in my daily emails the last few weeks. My spreadsheets in Excel have basically just started to fail on me. And so I'm actually in the process of trying to move different spreadsheets to probably 10 or 12 more functional, smaller spreadsheets rather than 4 or 5 really large ones. And what's happening is I don't know where all my data is anymore because I've been moving stuff over to something that works. So bear with me for 1 second. But yeah, essentially that's the answer. That I would say it's promising, right, for the short vol trade and long equities. Remember, short volatility is essentially anything that is positive beta to the S&P. You could make a strong case that just simply buying the stock market is a short vol trade, because obviously what's that position going to benefit from? Smooth markets, low volatility. So they're all short vol trades. And yes, we would want to see our barometer dip down closer to the 20 to 40% range and spend more time there. In the last 10 years, my barometer has spent about 45% of the time in that range. In the last 3 years, it's been significantly less. It very rarely even got there. And when it does seem to be some fairly quick reversals. So I think it's too early, but promising for sure. I see improvement in the market. Essentially, now I can show you the correct. Let's hope that I did this right. Yes, this'll do. So this is the volatility barometer going back 10 years, and you can see what I'm talking about. The average, all right, this is all messed up. The average is about 40, which from 2011 to 2018, you can imagine the environment we were in. Most of the time, cooperative, lower volatility with those occasional spikes. 2015 had, of course, the spike. 2011, European debt crisis. But since 2018 volpocalypse, we have clearly seen a significant jump up. And 17%, now it's averaging 57, might not sound like some catastrophic difference. But trust me, 17% on something like this, that basically bounces around between roughly 20 and 90, that is a huge difference. Definitely a volatility regime change. And if you want to even go further than that, we did a full live stream on the channel that I think you'd probably want to check out. Hopefully I named it right. Volatility regime change since volpocalypse. We covered a lot of data in there. And let's not get too excited, but things might be improving a little bit here. So that's what we want to see. Obviously, markets crash all the time. It definitely happens, and we should expect it to happen more. But what we want is volatility to find a lower base. And it does appear like that might be happening. So fingers crossed. So John Doe asks, what is the minimum account size that should be used with your strategies? I can't ever give out any personalized investment advice. I'm not a registered advisor in your area and can't ever advise on anything personally. But just speaking generally, and this applies to all investing, the more capital you have, the more efficient things become, right? Especially if you've got a reasonably complicated portfolio with, say, 4 or 5 different positions within it. The more capital you have, the better, because trade fees scale lower. You can do a little bit more with allocation sizing. With us, we are just trading ETFs. So I can certainly tell you the absolute minimum is for the tactical balance strategy, for example, it tactically rotates between MDY stocks, IEF bonds, or GLD gold. MDY is the highest priced ETF within that 3. So one share of the MDY is technically the minimum that's required. So what, 400 and what is it at? I can tell you exactly right now. What is the MDY at today? $495. So $500 is technically the minimum required. Now, depending on trade fees, that's going to scale poorly if you're just buying one contract. Now, fees themselves on ETFs are fairly cheap, if not free these days. But the larger problem, of course, is that if you have a small dollar amount and you're trying to trade a portfolio, the difference between one contract and 2 is huge. The difference between 21 and 22 shares is much smaller. The difference between 100 and 101 is negligible. So you are going to have scaling issues if you're trading on a smaller account. You can technically follow my work and probably other people's work as well. Same category. They're basically stocks and ETFs on as little as $500. Probably it starts to scale a little bit better at the 4,000 or 5,000 range because you're buying multiple contracts, and then you can sort of minimize that difference between when you can afford to buy 10 of them but can't quite afford 11. It's really not the end of the world. If if you have to wait until you have enough money to get 2 contracts instead of 1, yeah, there can be definite inefficiencies there. So apologies, I can't give you the direct answer, but something around the few thousand range is going to be starting to get more efficient. And then sky's the limit, scales upwards from there. Did you ask that twice? I think so. Okay, what tools do I use for backtesting complicated strategies? Good question. Nothing advanced, just Excel and Thinkorswim. So I can show you the Thinkorswim. Essentially, I can use interactive brokers as well, but Thinkorswim has what they call ThinkBack. You can just say, let's say I wanted to, backtest something with VXX. You can just type in your date. So let's say June 1st, 2015, and you can just go back and see what the options were trading at then. So the June contracts, here they were. The price that day was 1884 for the VXX, and you can go ahead and do back testing on anything you want, really. You could do SPY, you can do all that. Now, that's one way to do it. Basically, though, I don't do a whole lot of back testing, at least not anymore. I used to do a lot of back testing in around 2005 to 2010, but once I had several established strategies, 5 or 6 tactical strategies that use ETFs, 10 or 12 option strategies, iron condors, broken wing butterflies, all that stuff, the vol step, everything that we do, earnings trades, the wheel of fun, all of our VTS option strategies. Once you have a suite of 15 or 16 things that works, it's just a matter of tweaking. So if you are just starting your trading journey, then we're at a different stage. If I was doing back testing today, I would probably be out Googling softwares that can actually handle it better. Back when I was doing back testing, pretty much ThinkBack and Thinkorswim, or all the Time Machine and the other softwares, that was all we had. We had Excel plus that. So it was a lot of manual work. It was a lot of coffees at Starbucks. I would imagine, and I haven't checked, but I would imagine these days there are some pretty good softwares that are a lot more robust than that ThinkBack. So I would look for those. Unfortunately, I'm the wrong person to ask because I don't really require much back testing. I've been live trading for 15 years now. So it's more a matter of testing out short-term things, already knowing how the markets are going to react and all the input variables, what they're going to do, tweak them a little bit. What's that going to mean? I've sort of gone through all the pitfalls already of the trading. And so I don't really fall victim to all those things. But if you're starting your journey, yes, you're going to want to go out there. And maybe where's your question? I'm going to do some searching of my own, and I'm going to see if I can, the next time somebody asks something like this, see if I can point you in the right direction. But backtesting isn't really part of my daily work anymore. Hasn't for a long time. Okay, do you have any data on what day of the week the UVXY usually loses the most? I've noticed in the last few months it seems to collapse most on Fridays. So this is one of those questions that I think it's really good for traders to ask these. But the answer is kind of always the same. Start with the macro. Start with the big picture. Let's say, first of all, I could tell you, right? I don't have it on me, but I could find out, right? I've got all the data. I could just go in Excel and I could tell you that, wow, Tuesday, it turns out it's a little better than Thursday. What you really want to do as a trader is step back, start with the macro question. Does it matter? Let's say, for example, that I were to actually tell you, and this isn't true, I'm just using it as an example. Let's say I told you Tuesday is the best day and Thursday is the worst day. Does it matter? I mean, that's just what happened in the last 10 years since the product launched. Do you have a reason to believe that that would continue going forward next week? Would you actually bet real money on that? If I told you it turns out there is a statistical difference, wouldn't your brain initially say, well, that's just a 10-year data set. It's a very short data set. And if you have a couple of really bad days, the VXX largest spike was, 34% or something. UVXY probably much more than that. One-day spikes. If you have a couple of those that land on a certain weekday, and it just so happens that a couple of them didn't happen on a different weekday, you could have wildly different results that don't matter at all going forward. I mean, I know personally, if I were to determine the right answer to your question and tell you, rank them day 1 to day 5, I wouldn't put a single dollar on that from today going to next week. So it it really wouldn't be something that influences any of my strategies, even if there was a right answer. So first of all, I would say it doesn't matter. Secondly, it would be very difficult to design a strategy around a single day, sort of a seasonality around one day, because what are we doing when we trade volatility? We are using time as our biggest ally. We essentially understand there's a decay factor. We can look at the VIX futures and we can see the roll yield, and we can make a determination that all else remaining constant, this position has a statistical probability of making money over the next several days or weeks. It's really difficult to start getting that time frame down to a single day. I would say impossible. If you're trying to literally day trade seasonality of UVXY, I don't think you're going to get any success out of that at all, because that's not why we trade UVXY in the first place. We don't trade UVXY as a proxy for the stock market. We're not trying to make predictions. I think UVXY is going up or down. That's not what I'm doing when I'm, buying it or shorting it. I don't ever short it directly, but that's not what I'm doing. What I'm doing is capitalizing on the volatility risk premium and the long-term decay factor of the products. So why would I care if there happens to be a statistical one-day seasonality? That I'm sure there would. If you line up 5 numbers, one of them is going to be the biggest number, one of them is going to be the smallest. There is a right answer to your question. I just don't see why it would possibly influence what you're doing in your trading. So good question. Probably not a rabbit hole you want to go down. I don't think it's going to lead anywhere positive. So maybe just out of curiosity, again, I always like to data mine. I'll go ahead and check out the answer to that question, but my answer next time will still be the same. Turns out Tuesday's the best, and it still doesn't matter. That's going to be my answer. Also, can you do a video on backtesting? Yeah, maybe. I don't backtest anymore. First, I'm going to find out what the good softwares are these days. Try to get some answers on that. And then I will see what I can do with that, if it's helpful at all. One of the reasons I'm hesitating a little bit is because I know for me, my phase of that 5 or 6 year backtesting heavy phase in my career was super instrumental in developing all my strategies and basically making me the trader that I am. I don't really want to rob people of that experience by telling you, here's what you need to do, here's the best way to do it. I am a trial and error person. I really do believe, like, I was a pro golfer. I never had a golf lesson in my life. I basically just hit a shot, watch it go. Oh, it faded to the right. Well, that's not good. Now I have to keep the club face a little bit closed at impact. I have to adjust my grip a little bit. Hit another shot. Okay, I snipe hooked that one into the trees. Obviously, my grip was a little too strong. Keep adjusting. You get all these sprayed shots left and right. And if you hit enough balls, thousands and thousands of shots making small adjustments, you end up striping it down the middle of the fairway. Trading is the same thing. If you're entering your trading career thinking that you're not going to make mistakes, well, this is just unrealistic. You're going to hit some big snap hooks and you're going to lose some golf balls, figuratively speaking. But the more you do what works and the less you eliminate what doesn't work, I don't want to rob you of that experience. You need to go through that. You need to do what I did. Just hang out 10 hours a day at Starbucks and just pound coffee and backtest for 5 years. That's basically what I did. From 2005 to 2011, I was a backtesting machine. But I don't want to influence too much. It's another reason why I oftentimes don't recommend people read any books, because just because somebody said something in a book doesn't mean that it can apply to your journey. You have your own journey. Little tips here and there, options volatility books like that can help you with a few technical things, but you really want to be careful taking direct advice, like do these 3 things, don't do those 3 things, because maybe the things they told you not to do are going to be a vital part of your process, and you don't want to rob people of that. So I try to give guidance without direct statements of just, blanket, don't do this, here, definitely do this. Your journey might end up 5 years way different than mine. I like where I ended up. Obviously, I've got a portfolio that works very well, but I want you to go where you're supposed to go. And there's more than one way to make money, so I don't want to sort of force you into my way of making money. People follow my portfolio and subscription if they want actual trading guidance. They just want a portfolio that works. If you're on your trading journey and you're backtesting, go where it takes you. That's what I would recommend. There seems to be multiple. Oh, I see. You know what it is? I'm doing this to myself. I asked everybody to type question beforehand, so a lot of you retyped your question and put questions. So I'm highlighting multiple questions here. Sorry. All right. Yes, we're caught up here. What VXX strategies can we use to benefit from pops in VIX? Obviously, far harder to do than it sounds, because trying to accurately time volatility spikes is a difficult / impossible thing to do. So all I can really tell you is what works for me. It is very, very rare for me to go long VXX or long volatility, just pure outright long volatility. I do consider my VXX my VTS portfolio to be somewhat of a tail risk portfolio, in the sense that some of my best periods are when the markets are crashing. I do have everything set up. So, oh, that didn't load. Let me try again. I do have everything set up so that if markets crash, I have enough strategies that can gain long vol exposure that will definitely cover any losses for anything else that's happening. So let's try to go this route instead. I'll show you what I mean by that in a second. I don't need everything or heavy allocations long vol. Our tactical balance will only ever go to gold or bonds, which is enough. It's a safety position, but it's possible that gold and bonds go down during a extended recession. That is still possible. Not very likely, in my opinion. Probably at best tread water, but it might make a little bit of a profit. But it could also go down a little bit. Our tactical vol can go long VXX calls, but very sparingly. So to give you statistically, about 2.9% of the time, 2.9% of trading days, this strategy has been long vol. About 45% of the time, it's been short vol. And then the remaining, 52% of the time, cash. We're very often in cash in this range here. So it's a short vol, cash, long vol. And we can target that long vol, but only when it's really obvious that the markets are struggling. What you don't want to do is try to time long volatility when the markets are ambiguous. That is almost certainly a losing strategy, because most of the time, as we know, even if volatility spikes for a day or two, it does tend to get faded pretty quickly. So trying to be the contrarian and buy long vol, buy the VXX or the UVXY, probably not a good idea. Our VB threshold, kind of the same. We can be in stocks now, of course, because the markets have been good for a few months. We can move to safety bonds. And there's a little bit of a window above the 80th percent line on my volatility barometer, which doesn't happen very often. You can see here, we were only long vol for maybe a week. Doesn't happen very often. But again, it's when it's obvious the markets are struggling. That's the time when the VIX futures are going to be in backwardation, and you have a slight headwind, a tailwind if you're buying long vol, right? You don't want to ever fight the the VIX futures term structure. So right now, let's say you're a contrarian and you think, wow, stocks have been cooperating for so long, now's the time to strike. Now I'm going to buy that VXX. Well, you're fighting against a pretty steep roll yield in the VIX futures, and that VXX or UVXY, they're still going to be decaying. You have to be right not only in the direction, but in the timing. It has to be almost perfectly timed, or you're going to lose money, because these are positions that obviously we know they decay. And then the last strategy that we have can just move to cash or utilities. But my point was, very sparingly. You do not want to be that person that tries to fight against the long-term trend of the volatility ETPs that do fight a headwind most of the time. The VIX futures are in contango 84% of the time. So you better be certain when you're buying those things on the long side that you're going to get your timing right. Because in volatility trading, don't ever forget this, being early is the same thing as being wrong. So if you put on a trade and you are eventually proved right, which you will be, if you go long vol, eventually you'll be right. The market is going to crash, but being early is still wrong. Being early can cost you a fortune. So that the double element of direction and time is always fighting against you when you're trying to go long ball. So I would say I'm roughly 3% of the time, if that. I'm very, very careful. I'm only using it as a tail risk hedge for my portfolio because, of course, during the next recession, I want to make a bunch of money as well. So I do have them available, but I don't use it often. Okay, have you checked out the video I sent you on Twitter about public debt bonds deficits? It doesn't ring a bell, and you sent me on Twitter. So the first thing I would say is unfortunately, I just don't have the bandwidth to answer questions from all different places. So I typically only answer questions through email or YouTube comment section. Twitter, DMs, my DMs, I'm sure you can imagine, I've got quite a few followers on there. Questions come in every day. I just don't have the bandwidth to answer. So if you did send me something on Twitter, probably send it again through email. If you did send it through email, I know there's 3 or 4 links that people sent me right now that are kind of just waiting for me to watch. I just haven't had the time. So maybe you're referring to those. I'll get to them. I appreciate when people send me links, but I'm really busy. So sometimes I don't get to them. Give it a week or 2. I'll probably come up with an answer. Okay. I think your comparison between home ownership and renting has a flaw in its calculation. You are just taking the down payment for appreciation into account. You are just taking the down payment for appreciation into account. But since you control the whole equity, let's keep going, you would need to calculate the appreciation based on the total value of the house from month 1. I think I know what you're getting at. I just want to read that again just to make sure I don't go off on a rant and then answer the wrong thing. So I see where you're making your mistake. Okay. Perhaps it's a mistake on my end that I presented it in a way that might have looked that way. When I calculated, so this is all for anybody who wants to keep catch up. This is actually really important. I want everybody to go do this. Go watch this video called Rent versus Buy. It's a 25-minute breakdown where I showed why currently in this market, it would not be beneficial to buy a house in certain markets. In the US, it might still be, but certainly in a lot of Asian markets, it's absolutely not. A lot of European markets, it's not. Very good video, I think, that really gets to a lot of numbers. But I want all of you watching this to go watch this video because in the future, I'm going to actually create a spreadsheet that's downloadable for everybody. I want to make sure I'm on a screen share. Okay, I am. And then we're going to do another live stream where everybody can download the spreadsheet. You can have it in front of you, and you can input your numbers for the city that you live in, and we can all, at the end of it, determine whether where we live, it would be good to buy or sell the house, or to buy a house versus renting a house. You really need to go through those numbers. So what this person's getting at, good question. When I showed the difference between the renter who initially can put the down payment of the house into the markets and immediately start benefiting from that compounding versus the homeowner, I showed it based on the amount of interest and principal that is building. So when you take out a mortgage on your house, you don't own the house yet, right? You control the equity of the house, but you don't own the house yet. You have to wait 30 years till you own that home. So when I was showing it in that video, I showed what it looks like on a standard way where you're paying a lot of the interest first, and then in the sort of the back end 15 years, the principal payments start to come in and your equity starts to build a little bit faster. You're mistaking that visual that I gave for the actual calculation. So just to assure you, when I calculated the end result for the home buyer, I used the value of the entire home. I didn't use the breakdown of principal and interest. At the end of the 30-year period, you own the house outright, and that home went from a nominal value of, say, $500,000 to maybe $2 million. I included that. So don't think that I shortchanged the homeowner by only including the growing equity. I included the actual raw number as it would be 30 years later. And that's the comparison. The renter was still far further ahead. Now, that will obviously depend on your rate of return. If you're a good investor, renting is always going to be better. If you're sort of a buy and hold long-term type and you don't really have any active trading strategies, then maybe buying your home would just be a better allocation of capital because it's safer. You'll definitely make that money going forward, right? The benefit to renting and investing is that if you are a savvy investor and you can bump up that rate of return above, say, 7 or 8%, maybe you can get it to 10 or 12% a year long term, you're going to be far further ahead. But rest assured, I did include the home value based on the entire value of the home 30 years later. So maybe I'll go back and reconsider how I presented that to people. But no, it was pure apples to apples in all categories for sure. Okay. You both should come to Kiev, Ukraine. There are no restrictions. That'd be cool. I'm definitely interested in that part of the world. I don't know if you can tell by my last name, Osachov, but my family is Russian. So not a whole lot of, some similarities there for sure. I've never been to Russia, so I definitely want to make it a point to get over there in that area. So Ukraine sounds very cool as well. No restrictions, huh? That would be nice. I am a person who's trying to live a somewhat normal life, and it's a little bit difficult, but fortunately I'm able to choose where I go, so I'll put it on the list. Thanks for the suggestion. Okay, how long have we been going for? Not too bad. Okay, does the majority of our SVXY positions price action happen overnight? Yes. If you calculated the metrics at the end of the day, for example, long term, would you get the similar performance? So those are two different questions. Number one, yes, most market action happens overnight, as we know. Same with the stock market, same with volatility. The day session is only 8 hours long. There isn't a whole lot of volatility decay during that session. Of course, 16 hours overnight plus weekends, there's more decay available off hours, but also announcements, fiscal announcements, Fed stuff, surprises, those all tend to happen the majority of the time off market hours. And as we know, it's positive, right? Sometimes you get hit really bad. You wake up in the morning and the markets are just limit down ugly and you think, wow, I wish I didn't hold overnight. But the truth is you do have to hold those overnight positions because that's where most of the action happens and that's where most of the profit is made. As far as the second question, it is actually surprisingly the same or very, very similar. It varies year to year, but long term it works out the same. So whether I calculate my metrics like I currently do about an hour and 15 minutes after the market's open versus end of day, there have been years in the past where it might deviate, say portfolio wide 5 or 6%, but one year it will be at the advantage of this and the other to the other way. As you can imagine, it's just at the mercy of the market. So sort of longer term, longer than a day, it doesn't really matter. But let's say, for example, something really terrible happened on a certain day, and it just so happened that calculating the metrics at the end of day would have caught it or would have missed it, and the other one wouldn't have. Well, on a shorter time frame, that could matter significantly. Like I've had single days where my portfolio goes down 5% or it goes up 5%. I've had those days. So if the very, very short data set reflects a weakness there where one signal caught it and one didn't, yeah, you could end up at the end of the year, you could say, well, turns out doing signals at the end of the day would have been better. But when you stretch it out over 10 years, it stops to matter. And certainly over 10 or 20 or 30, I think it would be completely insignificant. So one thing I will say, though, the reason that I said an hour and 15 after markets open, I don't like to do signals too early in the session because that first 45 minutes, say, first hour, can actually be more volatile and you can get some bad readings. So I do like to wait until 10:45-ish, and then input all my data, send out the email, give everybody 4.5 hours to do their trades. It's long term, it's going to be the same. There are certain times it's frustrating. You look in hindsight, you think, if I just waited 2 hours, it would have been better, but that's trading. You can't avoid that. But long term, it's insignificant. Okay, there seems to be a few here. I'm trading VXX. It's working perfect against the SPY for a hedge. Do you mean as a hedge for the SPY. It's working perfectly against. I assume when people say trading VXX, I don't know why I always assume they mean going long. You didn't actually say. And there's this one. That's all I see. So good. I'm glad it's working for you. I don't personally hedge my portfolio. I showed the reason why. It's because I'm a tactical investor. I don't need to hedge. I use all my volatility metrics to, slowly move out of the higher risk positions and into safety positions with plenty of time to spare, right? I don't try to wait until the last possible moment. It actually doesn't take very much for the MDY to get to this level. Doesn't take very much to push us out to cash if we're short vol. That happens quite quickly. Aggressive vol is designed to sort of hang on a little bit longer. But my answer to the hedging problem, because of course hedges by very definition will probably lose money long term. My answer to the hedging problem is just being entirely tactical. I'm glad your hedging is working for you. It is much, much harder to do than people think. People think, oh, I'll just buy some SPX puts, or I'll just hold some UVXY, constant exposure, roll 1% or 2% of my portfolio week after week. It is so much more difficult than that. So I'm glad whatever you are doing is working for you. Question. I don't understand very well how to compute allocation of broken wing butterflies. You say, for instance, 0.5%, but I don't get how you compute how many contracts I have to buy or sell. Let me just use the current position we have, our live position right now in the in our vol trend strategy. So this is our broken wing butterfly right now on UVXY. I always mark the hash line whenever I open the trade, and this is a monthly contract. So it had, I think if memory serves, it had 25 days to go, and now it has probably half that. It has 9 days to go. So this is the trade. This is a broken wing butterfly. You can see down here, a standard butterfly would have been 22, 21, 20. All I did was break the wing, and I transferred some of the risk to the downside because I actually want I'm basically tempting the UVXY to go lower and cost me money. That would be great because I've got an entire portfolio that is essentially long the market right now. We are, what is our beta exposure to the market? I calculate that every day for our portfolio as well. Leverage, we are 1.4 beta factor to the SPX. So we are actually leveraged long in this portfolio and pretty standard, just 0.87 in the unleveraged portfolio. So I am essentially setting up this trade, check the screen share, to say, look, the UVXY is here now. I want my big profit range here. If UVXY spikes higher, I can't lose any money, which is awesome because when you're volatility trading, of course, the biggest risk is typically spikes to the upside. I have moved all of the risk from over here down to here, and I want the UVXY to go here. If I lose my full capital, that would actually be a good thing because it would mean that the rest of my portfolio is going to make far more than what I'm going to lose here. But this is the broken wing butterfly. So when you're telling me the risk that you asked the question, how do I say 0.5? All I did in this case was take the maximum loss based on the net liquidation value of this account. So this is our live stream account. It currently has 248,000. I took 0.5% of that and I risked that on the downside. So that's how I scaled this trade. Maximum loss, the most I could possibly lose if the UVXY crashes down, the most I can lose is 0.5% of all my money. So my net liquidation value would go down 0.5%. I can tell you with certainty the rest of the portfolio would go up several percent. So I'm obviously not going to be disappointed if that happens. That's why I set up this trade. It's called an overlay for a reason. I'm essentially just hoping UVXY goes down its usual amount. But if it happens to go down way faster than normal, well, I've got long-dated VXX options. I've got, my VIX options trade right now. I've got long stocks, long NASDAQ, long SPY. I'm covered. So that's how you scale this. Sorry. That's how I scale it anyway. So when I say 0.5% in the email for that specific broken wing butterfly, I meant 0.5% of the loss of the net liquidation of the entire account. Very easy to scale that way. You just, how much is in your account? Take 0.5% of that, put that money at risk on a broken wing butterfly. That's what we did for that trade. This is interesting. Yeah, I would imagine you're pretty good at this stuff. So Ilya says, I can speak on the R statistical programming language for various backtesting, at least for ETFs. I have told, I've said it a million times, I don't have any programming ability at all. So first of all, I would say that if you Google around, you will find some pretty sophisticated backtesting software these days. And then the second thing is, if you do have programming ability, then that's going to serve you well as well. I don't, and in my life, I'm so busy. I work insane hours. I just don't have the bandwidth to learn programming, so I'll just hire somebody. When I actually have a couple of projects I'm looking at that it will require something, so I'll just hire somebody to do it for me. But that's good input there. I know, I've heard of, I couldn't even tell you really what that is, but that's what a lot of people mention, that backtesting with programming takes a lot of the tedious work out of it. I can tell you in that 6-year period of my backtesting phase, back then I was drinking Starbucks Frappuccinos, those 450 calorie per Frappuccino. I was pounding 3 of those a day. I'd go to 3 different Starbucks, literally almost every single day for 6 years. 2 or 3 Starbucks, 2 or 3 Frappuccinos. Didn't have the six pack going that I would have liked. But yeah, you can do programming and you can cut out a lot of that just tedious hour after hour in Excel work that you can probably clean that up. Okay, would you ever just sell the data you collected? Not formulas, of course, but just the data points. I might. I can actually show you. I don't know if you can see this here, but you can see this master for sale spreadsheet. It's kind of just staring at me all the time. There's some issues with selling data. I'm not sure if I want to get into it. It's something that I've thought about. Give me some more time. Obviously, I've got some very extensive spreadsheets that I've seen the prices that people charge. To get the data that I would be selling in my spreadsheet, I wouldn't be doing it as a money-making thing. I never do anything for money purposes. I would do it for education. And then I know in my head on the back end, a certain percentage of those people are going to support my work. And that's how I get paid, essentially, is just to provide as much content and benefit and value as I possibly can. And then sort of on the back end is where I get paid. 90% of my work is always free. I give it out on articles, videos, live streams, all that stuff. And then eventually it does trickle back down to me if I do good work. So the selling the data would be similar. I might sell a spreadsheet for, say, $100 or $200. I've seen what people charge for them. And my data is more extensive than theirs. And they're charging $400 for this set and then $300 for this set. And I could do the whole thing, get 5 or 6 of those sets all in one for $100. So I might do that for people, and it might provide value. Obviously, I'd have to be a little bit careful sharing other people's data. I mean, I gathered it myself, so I don't think there's any, copyright issues there. But you never know. I'll look into it, and then also, it won't be, for example, it won't be all the very best metrics calculated out, right? For obvious reasons, I can't actually share the methodology of some of my best indicators. I've got articles explaining some of the basic ones that people know, but I can't go into any of these ones in detail. So the spreadsheet would omit those, of course, but give me some time. You never know. Maybe I'll think that if I think it adds value and it's actually has a place in my workflow, then yeah, maybe I would do that. Again, my bad. I asked everybody to type questions, so you did that again. Are you a CTA, or what kind of fund do you run, or do you need college to run a fund? So I am not a registered advisor. My basic history is I do have all the certifications to be a portfolio manager. I don't really know how it translates. I'm going to assume you're American. I'm Canadian. So I don't know the exact translation, but I know in the US, at least when I did these certifications, in the US, in order to be I don't know, able to actually trade, right? Able to actually manage capital. It was the Series 7 and Series 63, I believe. Back then, I think they changed the names to like 66 or something now, but Series 7, Series 63 was like everybody in the financial industry who wants to manage capital has to pass those. And then, of course, you can go further if you want. You can get your CFAs and your MBAs and whatnot, but you at least need those. So in Canada, our version is CSC and CPH, and I've done those. And then all the further versions, what did I do? WMT, PMT, AIS, DMS, DFOL. I've got tons of certifications. I just did sort of the whole suite of them. I've always been pretty good at test taking. I just read the textbook and kind of remember most of it. I've got a pretty good memory when it comes to just regurgitating information in school. I always found school basically an exercise in fact regurgitation, and for some reason my brain just kind of remembers what I read the first time. So I just took every test available possible. So I've got a lot of Canadian certifications, but I'm not registered because I'm a digital nomad and I travel the world. I'm basically a perpetual traveler. So to answer your first question, I'm not a registered advisor. You said, what kind of fund do you run? The word fund is actually a somewhat specific legal term in the financial industry. So you would never want to say that you run a fund if you don't actually run a fund. It's like saying that you manage a hedge fund when you don't actually manage a hedge fund. Like the word hedge fund is a legal structure. You can't say you manage a hedge fund because you're a financial advisor and you think it sounds cooler. Hedge fund is a very specific word. Fund in general is something you want to avoid unless you actually have a fully, registered fund. So I don't have that either. I manage a portfolio of my own investments. This is just my portfolio, right? The one that I always show here, this is live capital. I've had people say, oh, you always say test account. I call this my test account because my actual portfolio is at Interactive Brokers, my long-term portfolio. This is just money I put in so we could have something in our live streams and I could actually show a bunch of trades live. It is live capital, but it's not really my portfolio. But that's what VTS is. It's just my own portfolio. I'm sharing it with the public. If you want to follow, you know where to find me. If you don't and you just want to follow along for free, that's totally fine as well. Like I said, 90% of my work is free. But it's not a fund. It's just my own personal portfolio that I share the daily trades through email, and people execute the trades themselves. So I don't manage a fund either. And do you need college to run a fund? You don't need college for anything other than, do you think you can learn something at college that would give you benefit down the road? I don't know of anything, top of my head, that you can't do if you don't have a college degree. If you only have high school, you can do anything in the world you want with that. Especially now in this day and age, this is the best time for making money and starting businesses and getting your message out there. And you don't have to fall into any traditional categories anymore. Those days are long gone. Now, I'm not one of those people that tell people not to go to college. I still think that the overall experience of university is a good one. The only rules that I say is, number one, do it for the right reason, which is for you. Don't go just to party. That's ridiculous. Go to university because there's a lot of good things you can learn, even in a somewhat woke culture where you might want to, sort of more actively manage which courses you're doing and for what reasons. But go to university for the right reason. That's number one. Number two, don't ever go into mass debt to go to university. You don't need that. If you can go to an in-state college or university and it's really cheap, do that, of course. The statistics on how long it takes to pay off your student loans and how beneficial that is versus somebody who just went into a trade, for example, at 20 years old, it's pretty grim. Going to university and going into debt to do it is probably not a good idea, but I still recommend people go. I always look at it that, from age 18 when you graduate high school to age, say, 71, the retirement age, that's your career. If going to university takes you from, instead of 18 to 71 working years, 22 to 71 working years, you've basically lost nothing, but you've gained the university experience. You've gained, hopefully you've done it for the right reasons. You got a good degree that teaches you something valuable, probably want to focus on things like math, statistics, engineering and whatnot, things that are more valuable. But you've also hopefully done it for the right reasons, not to just get drunk all the time, but to actually meet some solid people who are going somewhere in their life. And you're developing relationships with people that can help you get way ahead in your life as well. Foregoing the university experience because you might not like the sort of the left-leaning wokeness, for lack of a better word, that's not a good reason to forego all the benefits of university. So as long as you're not going into debt to do it, I'd say do it anyway. Just where else are you going to meet the high quality people? At the gym? It's hard. I mean, in this world, it's hard to meet people. And, you might meet your spouse, you might meet your future business partners, you might meet a person who gets your foot in the door in the financial industry, a person who manages a fund, a person who is a CTA can give you a job because of what you never know. So I support people going to university. Just don't go into debt to do it. But no, you don't need university for anything. If you just want to skip what I've just said and say, I'll just be more active in developing social skills outside of school, that's fine. You can join a golf course. There's a lot of good business entrepreneurial people there. You could, I don't know. It's hard to meet people though. I mean, university is it's served up for you. If you're active in how you manage your university career, you can come out of there with value far greater than that degree. I mean, the degree itself isn't really going to impress too many people these days. This is the social media age. You'd be far better off spending your time getting 20,000 Twitter followers than getting a university degree. A future employer is going to look at your social media following with much higher regard than your degree. It's just the way the world is. But don't shortchange yourself. That's a long side tangent on something you never even asked. But I'm not a registered advisor. I do not manage a fund. I manage my own portfolio and I share it with the public. And you don't need college, but college is pretty cool. Don't overlook the benefits of having that phenomenal access to what is going to be the future entrepreneurs of the world. So don't waste 4 years just doing frat stuff, though. Okay. Just use RSI or MACD to see trend reversals, and they are free. Are you talking about the rant I went on about timing long volatility? I hope not. You don't want to use technical... Well, I mean, wrong person to ask. I'm not a believer in technical analysis, hardly at all. But you want to be extra careful doing any type of TA on anything volatility related. Of course, it just doesn't apply. The VIX, for example, is just a statistic. You can't really do much meaningful TA on something that's just a derivative of the S&P 500 options market. Why not just go straight to the source and do your TA on the SPY? I don't know why people would do TA on the VIX when all the VIX is a non-tradable statistic. And then when you're talking about the VXX, it's a methodology that trades rolling VIX futures that expire every month. So if you're trying to draw a line on a VXX chart between 2 points separated by 6 months, I hate to break it to you, but it's an entirely different underline from today versus 1 month ago, 6 months ago, 6 years ago. It's not even the same product. It's not the same market. So it's not like you're doing TA on Apple where it's essentially the same company the entire time. Volatility is not like that. Volatility is not TA friendly. I personally don't think anything in the market is very TA friendly, but certainly volatility. So don't know if that's what you were getting at, but there you go. Okay. I don't like to talk about other people unless I was interviewing with Chris. I'm aware of Chris and who he is. Are you acquainted with Chris Cole, his work in vol space, and his Dragon portfolio paper? Yes, on all counts. Could you give your thoughts on how to most efficiently go long vol in a traditional portfolio? I can't because I don't personally believe in how he approaches things. Nothing against him. He's obviously quite well known. And I think on a macro level, we agree on a lot of the same things within the volatility space. But as far as execution of a portfolio, that's where we deviate substantially. I just see no reason to hold anything long term. Like a rolling long vol position is just completely unnecessary. There's no reason to hold long volatility when the VIX futures have a roll yield of 15%. Like you're just throwing your money away. I mean, sure, you could get incredibly lucky, and as it happens, there's a market crash on the next day. But why would you hold something that you know for sure you have a headwind? So I'm a tactical investor. I would say, without getting too specific on his work, because I don't think that's fair. He's not here to defend himself. But basically, like the Vega Artemis fund, right? I will be holding the very same long volatility positions that he is when we both need it the most. The difference is the other 95% of the time, I'm not going to be holding it. Why would I hold something that I know with near certainty is going to lose money? It just doesn't even make sense to me. I understand the financial industry is set up in such a way that active investing with a bunch of clients there's challenges that they face. So institutionally, they might be handcuffed into just resolving themselves to hold long vol and just to bleed capital constantly during the entire bull market, and maybe for a few weeks here and there have a big payoff. I think that's a structural handcuffing, but I don't know why I have to be subject to that. I'm not in the financial industry, so why do I have to flush my money down the toilet? I just don't invest that way. So like I said, both of us will have the exact same tail hedge on at the right time. I would imagine his funds, his tail risk funds, will do just as well as mine do. Let's assume it's going to be more or less equal at the times we need it most. I would just say that my portfolio doesn't make 0% return for 10 years during a bull market. It's just that part of it doesn't make a whole lot of sense to me. So on a macro level, I like reading the papers, the work, I watch some of the videos. On an execution level, leaves a lot to be desired, in my opinion. And I think, as a former professional golfer who your entire life is based on performance, and now I moved into a subscription model where my clients can leave my service with the click of a button. Like it's just the easiest thing in the world for them to sign up and leave. I am 100% portfolio or performance based. I just, numbers speak for themselves. So I'm just not a believer in tail funds, like tail risk funds. I just think they're just leaving so much on the table. And probably it's structural. I'm sure that, if the cameras were off and the microphones were off, I'm sure we could find a lot of common ground on what we think. But when you're trying to manage $50 or $100 million of client capital, and you've got all these regulations and settlement rules, and it gets murky pretty quick. So I don't effectively trade my portfolio in any similar way to that. The biggest problem for SVXY option trading is the liquidity, especially when market is in turbulence. Yes, I don't know what this is in response to, but you should not, I hate absolutes, but everything in the vol space can be done with VXX options, all of it. So if you're ever tempted to trade SVXY options, just trade the VXX options. They're way more liquid. You get all the strikes you want. You get the weeklies with good liquidity. You get all that stuff. And you can structure option trades any way you want with any leverage factor you want. So if you want to simulate the SVXY, which is a minus 0.5 inverse, you can easily do that with VXX. You want to simulate UVXY, which is a long 1.5 times. You can do that with the VXX very, very easily. So yeah, I would default everything to VXX. Don't even consider trading the SVXY options. No reason for it. This question, I think you probably asked this before I talked about it, but I think I covered it a little bit, is just that hedging, much like the long vol constant exposure tail risk type idea, is extremely expensive and you will lose money. By very mathematical design, it is a bad position to hold because when you need it, great, it's there. But the rest of your portfolio is doing so bad that hopefully you haven't hedged so much that you're going to be making money. Because if you did that, if you bought a tiny hedge and then the markets crashed and you actually made money, well, that means during the bull market, your portfolio is going to lose a lot, right? Because you bought a lot of hedges and you're going to be bleeding a lot of capital. In order for your hedges to make more than your portfolio loses, you bought too many hedges, right? It's supposed to be reducing drawdowns. It's not supposed to be making money. So it doesn't matter how you end up at the place. One of them makes money, one of them loses money. I don't see that as necessary. I really don't. I understand that some people, maybe many people, I don't have, millions of clients. I just have a certain group of people that trust me to navigate going forward. But I don't personally think that people need to fall into the buy and hold camp. Most people have jobs, careers. Obviously, investing is very difficult, and you need to hire a professional to do it right, unless you're going to put in the hours. Everybody's capable of doing it, but very few people are capable of dedicating 5 to 10 hours a day for 10 years, right? It's just a time constraint. It's not an intelligence level or an understanding. Everybody can be a good investor, but it really, really does require several hours a day for several years in order to do it correctly. And the vast majority of people just don't have that time, so you have to outsource it to other people. So do you outsource it to people that put you in a buy and hold portfolio that has a constant rolling tail hedge and you're going to lose money and it's not going to be very impressive? Or do you want to dive into the tactical volatility world where you can still get the exact same benefit when you need it the most? You just don't have to give up that constant bleed. I mean, where's the VIX futures right now? There are literally people right now, many, many asset managers who are holding long volatility today. Contango at 10%, massive roll yield. We've got the VIX down here at 1835. We've got the VX30. I mean, as of today, the VX30 was 2060. So you've got the VX30 at 2060 and the VIX at 1835. Really, really big roll yield. We've got 12.2% roll yield. And there are asset managers out there, many, many of them, that are holding long vol today. Well, why? Why would you do that? I can tell you statistically, that's a losing position. It just is. Doesn't mean it's going to lose money. Anything can happen tomorrow. We could have something terrible and that position could make a fortune. But the point is, the best investing decisions you can ever make should probably mimic today. You don't want to be a contrarian. You want to be somebody who understands that basically, within a little margin for error, little confidence interval here and there, tomorrow is more likely going to look like today. That's just what's going to probably happen. Statistically speaking, there would be no reason to think the markets are going to crash tomorrow because they didn't crash today. So tomorrow's going to look like today. Tomorrow's roll yield will statistically probably be around 12%. And why in the world would anybody hold long vol today? It just doesn't make any sense unless you had to. Unless you had clients that are paying you money for your own salary, but you're also restricted by the financial industry to not hold that position. You have to buy and hold because of certain regulatory environment. And you need an income because you're an advisor and you need to, put food on the table. So you're doing what is mathematically not good for your clients, knowing that it's not good for your clients because you have to, because you're handcuffed and you need a job. I have the luxury of not doing that because my entire work is based on 100% of my own portfolio. And there's no way in the world I would hold the VXX today. It's just an insane position to hold. You can just tell mathematically that's just a dumb position to hold. So if I wouldn't do that to my own money, thankfully I've structured my career where I do get paid money that I also don't have to put other people in crappy positions. I can put them in the good positions that I put myself into. They can just mimic my exact portfolio, and I won't put people in long vol just to have them lose money long term. just to appease a mandate that I have in the financial industry. I think that's largely what's going on. I've had conversations with people that do that. Like I said, cameras off, microphones off. They acknowledge that the math just doesn't add up, but they also need an income. They need to get paid. They're a registered advisor. They have certain rules they have to follow, and I simply don't have them. So hedging doesn't make any sense, and I don't think those same advisors manage their own portfolios for their own capital the way they manage their client portfolios. I would be shocked if 90% of Wall Street, if you looked into their private trading account, it looks like their fund that they're pushing to the public, or those advisors that work at the bank that are pushing the pie charts that we see. I would be stunned and amazed if their own portfolio looked like that. I just don't think it does. I don't have any evidence to show that. I'm not privy to their trading accounts, but boy, I would think that that's probably not the case. So I manage my portfolio 100% the way that I feel is best. I'm wrong sometimes. I lose money sometimes, but I never do anything with a mathematical headwind. Just, why would you do that? Yeah, thank you. Vanessa's here for 3 months for sure, minimum, and I'm probably going to be annoying many of you with just an insufferable amount of pictures and little stories here and there. We haven't seen each other in a year, and we love to travel together, so you're going to have to put up with a few things. I'll try not to turn my Twitter account into something like Instagram, but I'll probably force a few pictures on all of you. And I am going to try to do some videos with some cool backdrops, so you'll see that as well. Yes, Series 7, Series 63, New York. It's for stockbrokers, salesmen. Yep. I was one of those back in the day. You're way more than that. Thank you. I appreciate that. Yeah, I ranted enough about my opinion of the financial industry for one day. Obviously, I'm extremely negative on it. Not the people. I always have to differentiate this. Never the people. We always say, oh, Wall Street advisors, they're idiots. They don't know what they're doing. Look at that guy's hedge fund. He makes 3% a year. What a moron. He's not. He's obviously highly intelligent, very educated, probably 20 years of experience. They're not dummies. Wall Street is smart. These are some of the smartest, most sophisticated investors in the world. Unfortunately, due regulations and through the simple fact that they are transacting for an income, there is a lot of regulatory handcuffing going on. And like I said, I don't think his actual portfolio looks the same as his public-facing fund that he makes money off of. So let's divide the, demonstrably garbage financial industry from a portfolio performance perspective, which is just a fact to say that it's bad. Let's divide that from the actual people, because they're perfectly smart and capable, and I'm sure some of them crush it in their own portfolio, in their own private trading. I guess the trick is to find somebody who has the least conflicts possible. That would be a pretty good place to start. If you've got no choice and you have to have your money managed by some factor of the financial industry, you probably want to try to reduce the number of regulatory hoops they have to jump through, the conflicts of interest, what banks they work at, what they're telling you versus what they know to be true. Minimize the conflicts and you'll probably be better off. But just in general, I can say I've met a lot of awesome advisors and super nice people, super smart, that have public-facing funds that are less than desirable for some reason. And that's something that they're going to have to grapple with themselves. I have the luxury of not having to do that. 100% of everything I say and do is what my actual capital is doing in my actual account. I don't share anything that is outside of that at all. This is my current portfolio. This is exactly what my money looks like, and this is exactly what you would see if you logged into my emails. Every position there is exactly MVV, SVXY, SSO, QLD. Everything is the exact same. So I have no conflict. I can just do what's best for me. And hopefully, by proxy, that means it's best for you as well. or at least you've selected that it is a good person to follow into the unruly markets and the uncertain future. If you think I'm going to be a pretty good captain of the ship, then you can follow what I'm doing. And otherwise, there's thousands of hours of free education. So this is interesting. It's way out of my wheelhouse, but enjoy the videos. Thanks for checking them out. Wealth Lab Developer 7. That seems like something to research. C+ programming or drag and drop blocks. Software does backtesting as well as algo trading via APIs with brokers. Is that English? Are you speaking English right now? Because I don't understand any of that. But for anybody else who recognizes a few of those words, there you go. This is answering the backtest question where, I'm old school, I'm Excel, but there you go. If you've got programming abilities, I'm sure there are really good solutions out there for you. Have you considered updating your site? Yeah, my website it looks like a child designed it because I have a child level of programming ability, so you get what you get. I should probably, again, hire somebody to just do a better job. But yep, I'll update the site by adding paid members area with all the perks and info of your paid subs. Email's also perfectly fine, but have you considered it? I have, and to be honest, I launched VTS in January 2012, and for the first several years, we did have member logins and member areas, but it gets messy pretty fast. I think for me, as a person who is not very tech savvy, most people are in my camp, and just the sheer number of troubleshooting questions that I used to get based on not being able to log in or error messages. As soon as I shifted everything to a single daily email where literally, everything that we share on a day-to-day basis, this is just today's email. I don't think I wrote a blog today. But all of our volatility data is in here. Of course, this could be put on the website as well, and I could hire a programmer to do all that, but it's all here. I mean, it's fine. It's in the email. Got all our data, got my blog, got all the trades that go out every day. If you're following this strategy, you just look at it and it tells you what to do. And then I've got, again, all the supplementary information organized, all of our live streams, public live streams, bunch of data like trade frequency for all the strategies, correlations of all of them, all of our max drawdowns for both of the portfolios, annual Sharpe ratios, max drawdown, all the data that people need to follow. It's all here in one single email. So it really just cuts down on a lot of the troubleshooting that I have to go through. I spend 4 to 5 hours every single day answering emails. It's probably almost half my workday is answering people's questions, and not live streams. I mean, just email, boredom, drinking a lot of coffee, answering emails, 4 to 5 hours a day. So if I have a sort of a more complicated website, that's one of the reasons why it looks so simple. It's just like, here's the portfolios and here's the subscribe button. It's very simple because my email gets out of control pretty quickly. For someone like me who has made everything completely public and open to everybody, when I see a question, I don't check if that person's paying me money or not. I just answer the question. So I don't even know what percentage of my workday is spent just answering general questions. So it's just the way that I always operate. The downside is I get overloaded because very few people in the vol space will actually answer your question. So I seem to be that guy that will sit on a live stream, that will answer emails. I won't check to see if you paid me money or how much you paid, or I just offer my help as much as I can. Uh-oh. We're going to have to disagree here. We'll agree to disagree, I think. We need another lockdown. Delta variant is infecting and killing too many people. Stock market would be fine as soon as the Fed keeps printing. We have to save lives first, period. That's great. I did a whole 20-minute rant on my opinion of it. And I will preface it by saying I've got my full passport done, and I did that immediately as soon as it was available. I just sort of differ a little bit with the lockdowns, robbing people of the ability to have a livelihood, a normal life, and certainly the intrusion of forcing people to do certain things against their will. You know, I'm just not one of those people. I wouldn't say I'm a libertarian, but I'm more of the mindset that, look, we have over 7 billion people in the world, and there's no way we're all going to agree on anything. Get 2 of those people in the same room and talk for 5 minutes, and you're going to start to have disagreements. So in a world where literally everybody disagrees with every single person on earth about certain things, it just strikes me as rather obvious that the only solution is max freedom, minimize the forced opinions as much as possible. If you can't get 2 people to agree on something and you pay them the respect to acknowledge that they're both intelligent, then you have to just let each of them decide for themselves. You just have to. There is no other way to do this. You can't say, you're smart, you have a degree and a great job and a family with 2 kids, and you're smart with a great degree and a family with 2 kids, but I'm going to tell you what to do and I'm not going to tell you what to do. We can't live in that. There's too many people. This isn't a tiny community. This is a global community. And every opportunity we can find to allow people to make choices for themselves is going to be the path of least resistance in society. It just is. Things get really messy really quickly when you start telling otherwise intelligent people what to do. It just can't work. It's not that we want it to in some ideal world. It can't work. You cannot do that. So this is one of those situations where I think, fortunately, we had somewhat of a miracle of medicine in the last year or two, where we fast-tracked and researched and came up with a viable, active solution quicker than, obviously, we progress over time, so it's not overly surprising, but the speed of which our scientists solved this problem, at least to an extent, is shocking. It's a miracle. It was wonderful. And now it's available on a mass scale. So what we should do now is default again to what I said. There's just too many smart people who disagree on this subject. You got to just let them all choose for themselves. I made my choice. It was pretty easy for me scientifically when I looked at the research to make the decision that I made. I just don't want to tell other people that they have to think what I think. So we will agree to disagree, my friend. I think lockdowns are a terrible idea. And I think on a cost-benefit analysis of what we're doing to the future, I don't think people are weighing the cost part. They're looking at the benefit. Okay, we're going to do this and we're going to save hopefully this many people. They're not paying quite enough attention to the cost part of it. The $8.3 trillion Fed balance sheet, the $28 trillion US debt, the ridiculous levels of inflation that we are seeing that the government's telling us we don't see. We're experiencing it day to day, and yet they're saying, no, don't trust what your wallet tells you. It's not actually happening. It is happening. There are some definite costs involved here, and we're at the point now where, fortunately, help is there for us. For anybody who wants to reach out and get it, it's there for us. So I think now is a pretty good time to say, look, let's go back to the not full libertarianism, but let's let smart people be smart people. Let's let them choose for themselves. Let's have some faith in humanity that most of the other people out there have just as much compassion as I do. They have just as much stake in the world as I do. They're just as much a member of society as I am. And if they make a different decision than I do, so be it. I can make my decision. They can make theirs. That's where I stand on this. It's just, God, 3 people in the same room, and very quickly you're going to be telling 1 or 2 of them pretty insulting things about their intelligence. If you start mandating things, you just can't do that. I don't like to be told I'm stupid. I don't think anybody likes to be told that. So let's just have a little faith that people are, if nothing else, assume everybody's selfish enough that they're going to make the best decision that they think they're making for themselves. Let's just assume that much. They've thought it through as well. Yeah, disagree. But I think what will happen, and let me rant some more here just because I think a lot of people emailed me and said I should talk more about this. I don't want to. I did what I did. I'm a vaccinated person, and I did it for my own personal reasons, my own family reasons, my own scientific understanding reasons. I do not want to tell a single person in this world that they have to do what I did. But I think what's going to happen is the world itself is going to provide opportunities for us to choose. Countries. There will be some countries that are just more friendly. Our friend from the top who said, come to the Ukraine. The world's going to go that direction. And this is a global society now. So if you don't like where you live, just because you were born there doesn't mean you have to stay there. I mean, I'm not telling anybody to adopt my lifestyle, but I move, I come and go as I please. I go where I'm treated best and where I feel most welcome and where I set up the best lifestyle. And I think the world's going in that direction. So we now have access to all the medicine you want. We have access. You don't have to do it if you don't want to. We have countries that are more friendly. We have countries that are very strict. It's a menu now. You can choose. And I am all in favor of freedom and choice. I choose wisely for yourself, and I'm making the assumption that you will. So I want you to have your choices. I want you to have the choice to go to Bill Gates' house or don't. I want you to have the choice to move somewhere and start a company for yourself or get a job and don't. Go to university or don't. Do whatever you want. I trust you. You're all intelligent enough to make good decisions. I'm not going to tell you what to do. So, talk about your relationship. I'll probably have to punt on this one. I'll tell you what he's getting at. Talk about your relationship with Prosperitas Financial. They do have a paid service too. Why should you choose them? This is weird. So you said, talk about your relationship with Prosperitas Financial. They do have a paid service too. Why should we choose you instead of them? Well, my friend, I'm not sure if you read this correctly, but I am Prosperitas Financial. This is me as well. I'm Volatility Trading Strategies, right? This is my main portfolio. 20% of my portfolio typically goes to option trading, so we have VTS options. And then I have a consulting company called Prosperitas Financial. I assure you, this person is also me. This is the same guy you're listening to right now. I'm Prosperitas Financial. So maybe a little bit confusion there. What it is essentially a consulting company that I've had for 10 years or so that I can actually partner up with registered advisors, because I'm not one, where I can actually partner up with people in a more formal atmosphere, and they can license and use my strategies for their clientele. So I offer my tactical strategies to registered advisors through a private agreement that we can reach, so that we pass all the legal hoops. And what people can do, of course, is just sign up for my subscription service, and then if you're an advisor, you just put your clients in those trades. The problem with that is, legally speaking, you would technically be withholding from your clients, unless you told your clients, by the way, some of your trades are actually coming from this other person. If something terrible were to happen to a portfolio, you might be legally on the hook. So I set up that consulting firm where we can actually sign a more formal agreement. We can introduce myself and my strategies to their clients, and everybody's in the know. Everybody's approved it and accepted that this is the arrangement. And then there's no problem. We can cooperate, and I can probably help some people be a little bit more tactical in their investing, and it's all on the up and up. So I am Prosperitas Financial. I don't talk about it ever at all because it's a private thing with me and hedge funds and private offices and whatnot. So I don't ever mention it. I've never once marketed it of any kind. But just to clarify, yes, same person. That is me. Mailing system is perfect. Don't change it. If a simple thing works, no need to make it. Yeah, appreciate that. I tried the logins. It was more headaches than not. Probably on my end, though, because honestly, it seems something that could be pretty easily done. I just have no design ability, no programming ability of any kind. So I don't want to become the guy that talks about this in every stream. So we'll try to skim through these. Not sure we need lockdowns so much as you can. Again, you're a super smart guy. We're in the same industry. You manage your own subscription service. You understand volatility markets. No doubt you're an intelligent person. I disagree with you. So now we're at an impasse, aren't we? We're two pretty smart people who happen to disagree on something. Fortunately, both of us can go do what we feel best for ourselves, our family, and our lives. I would suspect that both of us made the same decision at the end of it. Both of us visited Bill Gates' house, and both of us have family members that did that as well. The only place that we disagree here is what we are going to force other people to do. I'm never going to tell you to agree with me because I said so. All I would ask, and other people in society would ask, is kindly, good sir, please don't tell me what to do and to agree with you, because I might not. It doesn't mean you're smart and I'm dumb. It doesn't mean I don't know the research. It doesn't mean, oh, I'm on this side of the political spectrum and I wave this color flag and you don't. It doesn't mean any of that. It just means of the 7+ billion people in the world, every single one of us disagree on certain things with each other. You will never find a person where you agree with everything they say. That will never happen. So, are you going to be the one to tell me, honestly, that you're smarter than everybody you disagree with? I don't think we should go down that road of doing that. So, I totally respect everybody's decision to do whatever they want, as long as it doesn't directly intrude with my life. Obviously, don't steal my bike, don't break into my house, don't do certain things like that. Otherwise, don't drink and drive, don't, there's certain things that we just have to force people not to do. But like I said, we should make every attempt in society to minimize that as much as possible, because it's a very slippery slope and it gets very muddy very quickly. So now this turned, yeah, I can see it. How long have we been going? Oh, wow, 1:40. Sorry, everyone. How many people are watching? Quite a few of you. Thank you so much for sticking around. Apologies for the Bill Gates talk. It's not what my streams are about. We're all traders. We're all volatility specific options trading. It's just that this world, I mean, we got to talk about it a little bit, right? I don't want to be preachy. I'm not that guy. Like I said, I'll give you your right to choose whatever you want, as long as it doesn't overtly intrude on my life. You do you. I'm fine with that. Got to talk about it a little bit, but I do try to keep it to a minimum. And not for nothing, but I am a person who has a fairly, not unique perspective, but certainly I don't even want to say informed, but a lived experience, because I am a perpetual traveler. I am somebody who does a lot of research on which countries have which laws and which rules, and where is a good place to live, and where is somewhere that, you might have intrusive things. Where's a good place to set up a business? What countries will allow you to buy a home as a foreigner? Which ones won't? And I do think the world is, with this thing, this pandemic, I do think the world is going to splinter a little bit more. Obviously, it's my job to manage my portfolio the best way that I can, and I will do that. I'm always, like I said, VTS is essentially a tail risk fund that makes a really good profit during bull markets. That's how I've set myself up. So I had a great rate of return for the last 11-year bull market. I will also be right there ready to capitalize if we go into a 6-month recession. But we also have to find nice places to live and raise families and whatnot. So I have a little bit of perspective there. People can ask, and sometimes I share. What does this mean? Is it possible for you to share the daily market value of your strategies historically? I'm developing a custom one, and I'd like to calculate correlations. It's 20% for all 5 right now. It changes. It wasn't always the case. Like I said, I do what's best for me always. 100% of the time, I do what's best for my own capital. Everything I share in the emails is only something that I actually did with my money. So it's not always, 20, 20, 20 for 5 different strategies. I've had periods like when I launched VTS, it was 50% tactical balanced, 25% tactical vol, and 25% just iron condor strategy. And then over time, we added one called, very shortly after that, instead of just tactical vol, we had conservative vol and aggressive vol. And we did that for many years. And then VB Threshold launched in, January 2015. Defensive rotation wasn't there when all these years. Vol trend was kind of always there, but it comes and goes. So this itself will change. You want to pay attention to the daily emails, but I always specify what it is. We are in these positions. All of my positions are equal weighted right now. Like this I can even show you. They won't be exactly because, of course, cost basis changes over time. Am I doing a screen share? Make sure I'm not talking to myself here. They're all equal weighted. So MVV has, this is buying power. This isn't the actual allocation. But you can see all 3 of our S&P 400, NASDAQ, S&P 500, they're all equal weight. All 5 of these strategies are equal weight right now. So I don't think that I would have to show much more than I do show for people to literally follow exactly. And then I always go a step further and tell people as well, I execute my trades near the end of the day. And the performance that I post on the website to make sure that it's never subject to one of those situations where I say, well, I made this percent because I executed my trade at 2:15 that day and it happened to be beneficial. Everything is recorded end of day. So if you want to track almost identical to what I do, you can do that. You can just take the trades I say in the daily email near the end of the day, and your performance will exactly match up to what I post on the website. Beyond that, I don't want to add too much extra to the emails. It might look like it's a long email and complicated, but I want to keep it minimal, and I think it's pretty to the point right now. People can just scroll to the part that they are interested in, and they can skip what they're not. So I don't want to add any more right now. See if there's any more questions. Oh, here's a continuation. I meant the daily returns for each strategy so that I can calculate how correlated mine is to yours. Well, again, there's no reason to calculate it. It's either subject to luck of the draw. If you execute your trades at a different time of day, there's going to be some small variation there. But if you want to get exactly the same correlation, just trade when I do, end of day. Problem solved. You'll track exactly the website, exactly what I do. As far as daily returns, I don't think that's information I think is meaningful. I don't trade day to day. Even though we are available to exit and enter trades every single day, it's basically 1-day time frames. Doesn't mean I'm exiting every day. My goal is to get into a trend and hang in there for a month or two. That's the ideal situation. So I look longer term than daily, even though technically we are available to switch positions day to day. I'm not a day trader though. So there's always questions I can't get to. I've just been going too long, but yeah. Okay. I should call it there. Hour 45. It's a little bit too much. Thanks everybody for hanging out for so long. Next time I do a live stream, I will be somewhere else. I'm hitting the road, getting out of Vancouver, and heading to Banff. So hopefully, weather permitting, we will do a lot of nice hikes and kayaking and cool stuff. I was born in Calgary, so the Rocky Mountains are basically my backyard. But I'd like to give Vanessa a nice vacation. So you're going to have to suffer through a bunch of pictures. Apologies ahead of time. But we will do live streams. Probably next week I'll set one up. So thanks, everybody. Have a good rest of the week.